We're now going to take a look at question 8 in the question pack, and this is a step on from question 6 and question 7 because now we're looking at an acquisition of a subsidiary, but a prior year acquisition. So if you look at here, Ireland, the parent company, acquired 80%, so there's an NCI of 20%, but on the 1st of August 2011. We're now at the 31st July 2013, so it's a 2-year post-acquisition period. So that will be important when we're doing the FX differences because we're going to have to split current and prior year. So this is the last added complication you can get. So you see here the P&L for the year ended 31st July 2013, and you have the statement of financial position. And the investment in Joburg is €500,000, but all of Joburg's financial statements are in a foreign currency called bingos. And what you're asked then is you're given exchange rates at different periods, and you're told prepare the 3 main financial statements. Right. So again, we approach this as normal as we approach question 7 as well. First thing you're always going to do is you're going to be setting up the question. So you'll set this question up like you set up a vanilla one. So in mine, I would have a page left for the statement of profit and loss and other comprehensive income. I would have 2 pages left for the statement of financial position. And I leave a page then for the statement of change in equity, which we'll do at the end. But leave your answers, the main financial statements, in the front of your booklet. And then I would leave, because it's FX, I'd leave 2 or 3 pages for your big workings. It's usually just group retained earnings, NCI, and goodwill. But you'll have a big working now for FX at the start of this question because it's IAS 21. And then after that, we do our small journal 1, journal 2 for any of the smaller adjustments. So set it up as you mean to go on because these are big questions. They'll be over an hour in length, so you have to make sure you have a good structure to be able to follow it as well. So the first step you're always going to do is you're going to take the statement of financial position of the subsidiary and you're going to translate it into euros. So we're going to go from Joburg's bingos into Joburg's euros. So we have to do all this setup because you can't calculate goodwill until we know what the euro financial statements look like. So there is a couple of steps to set it up. The rules under IAS 21 are closing assets and liabilities at the closing rate. Now that's the rate at the end of the year. So we go back to the question. You see here the rate at the end of the year was 2:1. So we're going to divide by 2 here, 2 here, and liabilities divided by 2 as well. So they are the IAS 21 rules. Doesn't matter when it was acquired in terms of this, it's going to be at the end of the year rate. So divide by 2 and divide by 2. So your total assets there are going to be 875. Your non-current liabilities are going to be €60,000 and your current liabilities 160. So that's always the most straightforward one, is any assets and liabilities are converted at what we call the closing rate. Any equity, or the ordinary share capital, will be converted at the historic rate. Now the historic rate here means the date of acquisition, which will be 1.6. So 300 divided by 1.6, put an equals there, is 18, no, we'll just round, keep it to the same solution, 187.5. Now what I usually leave for retained earnings, because there's actually a couple of things going on there, for now I always just leave it as a plug figure. So put that as yellow. You'll see the same approach in all the other questions. That plug figure must be something to make the base statement of financial position balance. So you're saying 875 minus 160 minus 60 minus 187.5. So in this case, if you go to 1, your plug figure is 467.5. Now we have to prove what that plug figure is, and we have to prove what's in it. But your first step always is convert it to the statement of financial position in euros, because we're going to use that in our answer then to add parent plus sub plus adjustments. So that's your starting point. And in that plug figure, the plug consists of 3 things. And this will always be the same 3 things. The 1, pre-acquisition retained earnings at the historic rate. So in our case here is, well, the retained earnings at the date of acquisition, which in this case we are told are 540, 540,000 divided by 1.6. Divided by 1.6, sorry, keep putting the plus in, is 338. Just make sure it's not rounded. 337.5. Just try and keep it to the half as it matches the solution. So that's the one that's going to be going to our goodwill working, because they're pre-acquisition retained earnings. Then, now you have to be careful here. Post-acquisition retained earnings at rate when earned. Now what does that mean? It means, the reason I'm saying that is you have 2 years post-acquisition. Year 1, 1st of the 8th 11 to the 31st of 12th 12, 31st of the 7th 12 should I say. And then year 2 is the 1st of the 8th 12 to the 31st of the 7th 13. So what I'm trying to show you there is there's 2 different post-acquisition periods. And that's what complicates things when you're dealing with a prior year acquisition. In year 1 and you have year 2. Now year 2 post-acquisition retained earnings are straightforward. They are the profit for the year 2013, 240. But you have to actually be able to work back and figure out what the post-acquisition profits last year were. And how you do that is, you take retained earnings, put it here, retained earnings 31st of the 7th of 12. We know retained earnings at the end of the year for the sub, or 1010. We know retained earnings at acquisition were 540. So that means post-acquisition profits, 2 years, were the difference. Total post-acquisition profit was 470. So the 2 year, if we know what this year's is, which we call the current year, well then we come back into 230 in this one. So that must be prior year post-acquisition, because both of them together are your 470. So it's an added complication there when you go across. So technically the rules in IAS 21 are you convert each of these at the average rate they were earned. So what was the average rate for year 1? Because that's what the P&L would have been converted at last year. What's the average rate for year 2? Now there's a small simplification in this one, that if you go and you look at the exchange rates, I only give you one average. Now technically that's a type, but that should read to 13, that the average over the 2 years was 1.8. You will see in another exam question, which I think is question 9, called dance, there's actually 2 different averages for each period, and you have to do them separately out. So this is a small simplification here. You're supposed to use the average related to each period. I've just made it easier that it said the same average for both. So here, it's going to be 230 divided by 1.8, and here it'll be 240 divided by 1.8. But I said the 1.8, it's coincidence here just to simplify things that are the same. And I'm just going to round these to make it easier. So that's 128. So we'll say 128, and this is 133. Right. So when you bring those together then, that means you have your retained earnings. And we know the plug overall equaled, if we put it in, your plug figure was 467.5. So we need to figure out what is the balancing figure here. Because if you add these up, it comes to 598.5. So clearly there's, and this is important, cumulative FX differences. Now that word is very important in this question. Cumulative FX differences, and that must be the difference. So it's going to be 467.5 minus all of these. So the plug figure, to make it work, must be minus 131. So they're FX losses. I'll just tidy that up so everyone can see it neatly. So what we're saying there, in that plug figure, there's actually retained earnings of 598.5, and there's a cumulative FX difference of 131. That makes your 467.5. So when we're splitting that out, there's 2 separate things going on there, and we can prove where that 131 comes from, which we'll do in a second. So that's an important second step, is get the plug figure, figure out what's in the plug figure, The 598.5 we're now going to use for goodwill calc, this element, and for sharing out post-acquisition profits between the parent and the NCI. This cumulative FX difference is going to be used for the OCI, which is IAS 21. So the next step then is to prove where the 131 comes from. Now the first thing I want to show you is, think about what this means, cumulative FX difference. So we have the 1st of the 8th, 2011. We have the 1st of the 8th, 2012. And then we have the 31st of the 7th, 2013. So the cumulative FX difference covers all 2 periods in yellow. So that's what we call cumulative FX difference, and that equals minus 131. So this is an important point when you deal with prior acquisitions. Now, that's the first thing we're going to prove. From the acquisition date to now, the FX difference is 131, and we'll look at that in a second. But we then also have to be able to explain what is the current year FX difference. And the reason we need to know that is that goes to the current year OCI in these financial statements. So the 131 will not be the one that's going to the statement of profit and loss and other comprehensive income, because that's for 2 years. Some of this portion, is actually prior year, and that will be in the opening balances of the statement of changes in equity. So it's important to be able to split out current year and prior year FX differences, which you wouldn't have had in question 6 or 7 because it was only current year. So let's prove then the 131 from a cumulative basis, and then let's split it out on a current year basis as well. Remember, this is all still working one, so there is a good lot to set up a question for a foreign sub. So let's look at FX difference 1 then, and that's for 2 years post-acquisition, from the 1st of the 8th, 11, to the 31st of the 7th, 13. And we look at opening net assets, and they are, if you look at your opening net assets, remember now we're looking in bingos initially, it's going to be the share capital, which is 300, and the retained earnings at that date, 540. 300 plus 540. So it's 840. And that is B. So we know the difference arises then because they would have been converted at the historical rate, which we know from the question if we go back. Historical rate, the date of acquisition. So the opening rate, first, that 2 years ago, 1.6. 840 divided by 1.6, which is 525. Just double check. And then everything else will be converted at the closing rate, and the closing rate in the question is 2. 840 divided by 2. So that's going to be an FX loss for net assets of 105. So that is an FX loss for 2 years. So it's not the current year, it's both years put in for 2 years. So that's your first element, FX difference 1 for 2 years. And I'll show you how to do FX difference 1 for the current year as well, because we'll need that for the P&L. So then we go and we look at FX difference 2 for 2 years, which deals with post-acquisition profit. And you have a lot of this done already, remember, because we've done initially in our translation. We said the post-acquisition profit was 470. Now, remember, there's a bit of a simplification here. We don't need to split out the 230 and the 240 because they just happen to be at the same rate. If they weren't, like you'll see, I think in question 9, Dance, you'll have a bit more work to do. So here, that is going to be at the average rate, which is 470 divided by 1.8, which I said rounded was 261. And then at the closing rate, which everything else would have been, which causes the difference, is 470 divided by 2. So again, it's a loss because the stuff that's converted at the closing rate is lower than everything else, so there must be a plug figure. And that loss will be 26. So that's what we call FX loss 2 years. And thankfully, when you put them together, a loss of 105 and a loss of 126 is FX difference 1 and 2 for 2 years is 131. And that is, just to be clear, that's a loss. That's a debit to your equity section because it's drawing it down. It's a loss overall. But that's your steps you'll do in every FX question is you'll get your plug figure, translating the statement of financial position. You'll prove within that plug figure, because we'll be using these now in the normal good group retained earnings, NCI and goodwill calcs in a minute. And then you prove what the FX difference is. Now that's fine. We know the FX difference is 131, and that's going to be split 80-20 between the parent and the NCI. You always split that out, and we'll do that in a second. But the other nuance that we have here, because it's a prior year acquisition, is we need to know the FX difference 1, and I'll put it across here. We need to know that, and I'll put in brackets, for current year only. What's the current year one? 1st of the 8th of 12 to the 31st of the 7th of 13. Because we can't put that full 105 in the OCI this year, because some of it was for last year. So how you do that is you have to figure out what is the opening net assets at the 1st of August, i.e. the start of the year, the 1st of August 2012. That will be 300 plus 540, which is the net assets at the 1st of August 2011, plus, be careful, the 230 that you earned prior year. So you're adding on the post-acquisition profit the prior year. So your retained earnings actually at the 1st of August 2012 would have been 540 plus 230, which is 570. So add on 230. So 1070. Now, you have to be careful here now. This is where students get caught. The historical rate now is not the 1st of August 2011. It's the 1st of August 2012, because you're only looking at a 1 year difference. So the historical rate here is the opening rate 1 year previous. So that will be 1070 divided by, that's why you're given 31st July 2012, which is the 1st of August, i.e. the rate at the start of the year, divided by 1.5, which is 713. And the closing rate is still divided by 2, is 535. So your FX loss there for 1 year, which is the current year, is 178. Same logic, your FX difference 2 for the current year. You're going to look at your profits for the current year, which is just 240, because you're only looking at one 12-month period. And you're saying the average rate here for this, so it actually doesn't change because it has been the same. The average rate was 1.8, 240 divided by 1.8, and the closing rate is 2. That doesn't change. So we're not looking at 2 years now, we're only focused on 1 year, and the FX difference 1 and 2 for current year, that'll be important for the P&L, is 178 plus 13. So that should be 191, just allow for rounding. So we'll keep it the same as the solution. So there is a lot going on there. So we know the 2 year is 131. We can say current year loss is 191. So that actually means you made a prior year, be careful, prior year gain of 60. Because a loss of 191 plus a gain of 60 gets me an overall loss of 131 over the 2 years. So that's what we're trying to show you with this split. This is minus 131. This is minus 191. So here, the prior year, if I put it a different color again, say green, prior year FX difference must be plus 60. So that 60 is going to be in the statement of changes in equity in the opening balances, like any prior year adjustment. This 191 is going to be split in the OCI this year because it's a current year, and the 131, the 2 years combined, is going to be in the statement of financial position. Now that is by no means easy, but that's the standard that's expected in terms of if a prior year comes up. Now look, if a prior year foreign sub comes up, you'll have a lot less adjustments. So it does balance out in terms of time required. So that's your big working one to get all set up like that. We'll do a small little journal, just so you'll see it in some of the solutions just to make sense of it. We do journal 1, what we say is we credit retained earnings of the sub 131, and we debit group FX reserve, and you debit NCI 80% and 20%. Now, what does that actually mean? What we're saying here is the retained earnings, the sub, what we've retranslated here, that 4675, actually that's understated, because the true retained earnings we've said are 598.5, 131 higher. So we increase the retained earnings, and that loss of 131, that's your FX reserve. But we know the FX reserve, when we come to the statement of financial position, has to be split between the group, which has its own section, and the NCI. So that's the cumulative 2-year, and a good student, what they'll put there is, they'll put here 3 stars, 191 current year FX loss. So you'll know there that actually the 131 doesn't go into the OCI, it's 191. And you've done that in working one. So quite complicated there, a nice bit of work involved. So this is the hardest you'll get in terms of consolidations. So once you've that set up now, we have a euro set of financial statements. We have all the FX differences done. We're now going to come to our normal working 2, which is usually our working 1, but we have to do FX first. We're now going to do goodwill. Like we would do normal goodwill for anything. We're going to do investment, and we're going to look at the parent, and we're going to look at the NCI, and we're going to look at the total. So that is 80%. Just leave it like that, just so you can see it. And 20%. Just always write down, you'll be amazed when the students get the figure wrong. The investment figure, we're given in the question, 500,000 euro. And we're also told that the NCI is measured using method 1. So that means we don't know until we get the fair value of net assets at acquisition. And that's actually done already. It's made up of ordinary share capital and retained earnings. Be careful now, this is all in euros. So you have to use the translate. The amount of students who put in the wrong figure here. The ordinary share capital is not 300,000 bingos. The ordinary share capital here is 187.5. You use the euro figure. So here it's 187.5. Let's just put that out just to be consistent. And we know pre-acquisition retained earnings, we've done already, don't reinvent the wheel. We're 540 at the historic rate. All the goodwill translation is done at the 1.6 initially, 337.5. 337.5. So fair value net assets, we don't have any fair value adjustment here. You will have it in other exam questions. So that's an added complexity that you'll come across. And the NCI then is 1/5 of that, because that's how method 1 works. So that's 605. And your goodwill there, the difference is 80. So that we call that goodwill at acquisition, which is the 1st of the 8th of 11. So what you're looking for here then is, if you actually split that across, you would see the parent would get 80% of that share. The NCI would get 20%. There's no goodwill attached to the NCI. Now that's important because remember, if there's no goodwill attached to the NCI, it gets no goodwill impairment. We don't have it here, but it also gets none of the FX differences associated with goodwill. Because we know in IAS 21, that's goodwill 2 years ago. But the goodwill at the year end, 31st of 7, 2013, needs to be retranslated. And how you do that is, you say goodwill was 80 2 years ago. You multiply by the exchange rate 2 years ago, which was 1.6. That will bring it back to what it was in bingos. So 80 times 1.6. Goodwill was actually 128 bingos. And you now divide by 2, which is the closing rate at the end of the current reporting period. Divide by 2, which means the updated goodwill is 64. So your goodwill at the reporting year end now is going to be 64,000. So that's how you retranslate it. That's it in euros at the acquisition date. You bring it back into bingos at that date by using the historic rate, and then you divide it by the new exchange rate, which is 2 years later. So goodwill at the year end is 64. Now what I'm going to do in Journal 2 is to show you the little workings to say, how do I recognize that gain or loss on FX? Right, so you can do it in the working if you want. I just keep it separate as a little working. Our journal to show you the debits and credits. So goodwill at acquisition, 80. Goodwill at 31st of the 7th of 13, we said was 64. So the cumulative FX loss, that's important, over 2 years is minus 16. So you have a 16 loss. I would put that as a nice tidy one. So the debit and credit there is to debit FX reserve, 16, credit goodwill, 16. That's the entry, because remember the NCI gets no hit of this because there's no goodwill attached to the NCI. If the NCI was measured at fair value, method 2, then it would be attributable at 20% of the loss. But what you have to be careful of now is that's not the amount that goes to the OCI this year, because that is the loss over 2 years. What we need to know is what would goodwill have been at the 1st of the 8th, 2012, or the 31st of the 7th, 2012 if you want. What was at the end of last year? And that would have been 80 times 1.6 to get me the goodwill and bingos at the acquisition date, and then divide by the rate that was there at the end of last year. See why it's complicated? Divide by 1.5. So what we can see is prior year you had an FX gain of 5. And then from the start of last year to the end of this year, that is current year FX loss of minus 21. So that's where the 16 comes out of. But this will go to the P&L. This will go to consolidated statement of changes in equity. And that's important that you understand that split. You're going from 2 years ago to 1 year ago to now. This is current year, goes to the current year's financial statements. This is prior year. That will appear, and I'll show you, in the opening balances on the statement of changes in equity. So that's important that you understand that dynamic, and that's only relevant when you have a prior year acquisition. Right. So that's another one complete, your goodwill working. What we'll now come on and do is we'll go and finish off the other normal workings that we have. We're going to do working 3. Let's do NCI. So you see, once you have all the groundwork done, a lot of this is very similar to vanilla questions that we've covered before. So the value of the NCI at acquisition, which is coming from working 2, we said the NCI was 105. It has FX difference 1 and 2 coming from journal 1, and we said they're going to get a share of the FX differences. They don't have an FX reserve, just all lumped together. Debit NCI means reduce the NCI by 26. So your NCI here, minus 26. And that's done already, and the examiner can see where it's coming from. The other thing the NCI will get is share of post-acquisition profit. Now remember, we've done this already, so you don't reinvent the wheel. The post-acquisition profit we have in working 1 is 470. Now be careful, that's in bingos. The post-acquisition profit in euros which you want are these two, 261. Both of them are converted at the average rate. That's the figure you use. So be careful that you're always thinking, am I using the euro figures? Post-acquisition profit, which comes from, in this bracket, working 1, is 261, which is then converted at the rate. And the share here is 20%. So the share is 261 times 0.2, which is 52. The NCI gets none of the goodwill FX because it's not measured using method 2. So your year-end good NCI is 131. NCI at 31st of the 7th of 13. So very similar to what you'll have done in vanilla questions, just you have to add a complexity, make sure you're taking the euro figures. Working 4, similar one, group retained earnings. You start off with the parent. So the parent retained earnings at the year end. This is how we always started off. So we're looking what is Ireland's retained earnings. Ireland's retained earnings at the year end, 4650. And to that, you don't put any of the FX differences in here because they have a group FX reserve, but you do put the share of post-acquisition profit. And they get 80%. And again, we're using the euro figure translated, 261 times 0.8, 209. So the retained earnings at the year end, 4859. Now again, in an exam question, you might have another couple of adjustments, unrealized profit, goodwill impairment, but for now we're just getting to grips with the basics of the FX questions. Finally then, working 5, group FX reserve. You have FX difference 1 and 2 from journal 1. And you have FX on goodwill, which is journal 2. So you're just putting in those again. Journal 1 is a loss of 105. Journal 2, be careful you take the full amount, is a loss of 16. 2 debits, which are reducing or losses to the FX reserve. So I'll just take these to tidy them up. Minus 105, minus 16. So your closing one here is minus 121. The group's share, they get 80% share of FX difference 1 and 2. They get 100% share of the FX difference 3, the goodwill. And that's a negative in your equity section. But a lot of that, the hardest part here is the working one. Doing all of those down, and particularly the tricky bit about splitting it between current year and prior year. You don't need to prove prior year. If you tell me what the cumulative is, and the current year will by default, the prior year will fall out. But it just takes a small bit of practice. So that's all our main workings done. We then come up to the statement of profit and loss, and we're going to convert Joburg at the average rate. And it's the average rate for this year, which you go back to the question, is 1.8. So you're dividing everything by 1.8 and you're just working down along. So 133 for the year. Just tidy that up that it's... So 133 is the profit for the year. And you will notice if you go down to your workings, we've said that already. There's the 133. For the current year, 240 divided by 1.8. So you will have a lot of things you can sense check your answers on. So in our question, we had no real adjustments. So it is just parent plus sub. Now just be careful there. You don't add in the bingos, you only add in the euros. And you add them down along. So you have profit for the group for the year. Now again, I'll just tidy that. Of 1203. So it's parent euros plus sub euros. No adjustments here, unlike you'll have in exam questions. But the point is you'll now have an other comprehensive income section as well. So you put in other comprehensive income and you're going to have FX differences on translation. And this is where you need to be careful. A lot of students make the mistakes. You're putting in the current year only. So here we're putting in minus 191. Right? Why? Because that's the amount that was in the current year. There were 60 gains, 60 of a gain, which was prior year. And that will be in the statement of changes in equity. And I'll show you that at the end where that appears. Likewise for the goodwill, you're putting in the current year loss of 21. Minus 21. So the total FX differences are a loss of 212. So that's an important when you put in the right ones and you put them full. You only split them then down the bottom. So technically this should have a capital S because this is going to be split. 80-20. This one will not be split. It's all given to the group. So that's your total comprehensive income for the year is 1203 minus 212, which is 991. And where you lose marks if you don't give it, you have to strip profit attributable to parent and NCI, and then you have TCI, total comprehensive income, attributable to, same again, parent and NCI. So there is a nice bit of work at the end, and that's important because it goes through the OCI, you have to split them out. So for the NCI here, they're just entitled to 133 of the profit times 0.2. Right, there's no different adjustments there because there's no unrealized profit or anything like that you would normally have in a vanilla question. And that means the difference, 1203 minus 27, must be going to the parent. So there's your 1203 split out. So this is where you have to be careful now where the IAS 21 piece comes in. The NCI now, so I'll just put there, that's just 133 times 0.2. Here then the NCI is going to be 27, which is always your starting point, the share of the profits, plus minus 191 times 0.2. They have to get their share of the FX difference 1 and 2 current. They don't get any of this, they just get their share of the 191. So that's going to be 27 minus 191 times 20%. So they are going to be, just to match the sushi for round, minus 12. So you can minus 11, minus 12, you're not going to lose answers. I'm just matching the solution that you'll see. You don't have to prove the parent. The parent is going to be the difference, 991 minus 12, which is 1003. And there's your 991 overall. So make sure you understand where they're coming from. You have to be able to prove what the NCI is. The parent is whatever's left. So that's your key statement of profit and loss and other comprehensive income. You then come to your statement of financial position. Now be careful here. You put in the right figures. You don't put in the subsidiary in bingos. You're going to put in it translated. So the PPE was from working one. It was 450. The investment, they don't have any investment. Their current assets, 425. Their share capital, we said here, was 187.5. I don't even bother putting in the retained earnings because that's going to be a working in itself. And the liabilities are 60 and 160. So just make sure you put in the translated amount, and that comes from working one. To show the examiner, I know that's a separate working. You'd be amazed my students who just throw in the bingo ones and add them across. So there's no adjustment here for PP. You're just going to add across. We don't have any fair value adjustment, which you might come across in other ones. So it's a nice straightforward one. Investment in Joburg, that is gone, minus 500. Let me just tidy that. So that's going to be nil because that's gone against the goodwill. You are then going to have goodwill from working two, and we said that's going to be 64. The retranslated goodwill at the end of the year. And your current assets, you just add across as well. So that means your total assets, and we'll tidy it up as well, is going to be 8069. So there's not much work there, just making sure you take the euros and you put in the right goodwill figure. Ordinary share capital, you never have the subsidiary there. So you take it out. So it's just going to be the parent, 2 million. The retained earnings we had, and the NCI, now I have to leave an extra line because we have group FX reserve as well. But oftentimes you won't be doing this till the end. So just leave plenty of space. Even if you put in subheadings, leave a couple of extra lines. That is NCI and that is FX reserve. So the NCI is working 3. The group retained earnings are working 4. And the group FX reserve working 5. So you don't have any workings to do here. You've it already done. All you do is slot them in. So retained earnings working 4. We slot it in. 4859. NCI working 3. We slot it in. 131. And group FX reserve, we slot it in, which is a minus figure, minus 121. So your total equity then here, which we're going to use for our statement of change in equity, 6869. Non-current liabilities, just the sub, and then parent plus sub for current liabilities. So there's a small bit of time done wrapping it up at the end, but the key point is have your workings done, have them nice and neat, and if they're done, that's where the bulk of the marks are going. So if we add up equity and liabilities, we're thankfully getting to 8069 as well. So we know we're on the right track if we've balanced the statement of financial position. Right, so that's the second statement. The last statement then, we're going to take these 4 items and we're going to do a consolidated statement of change in equity. So consol statement of changes in equity. You're going to have ordinary share capital, retained earnings, NCI, and FX reserve, and you're going to have the total. And then all of these are in euros, thousands. And where you start is you start with your balance, the closing balance, 31st of 7th, 13. And they're given directly in the question. Right, so your closing balances are here, 2 million. Let's see where it across. So you have 2,485,9, 131, and minus 121. Just tidy that up to make sure it's easy to see. And then the total equity at the closing is 6869. So you always start with that, and you're working towards the opening balance. The opening balance is the 1st of August 2012, now remember. Statement of change in equity only looks for 1 year, even though you owned it for 2 years. We didn't have any share issues, we didn't have any dividends, we didn't have any acquisitions during the year, that happened last year, and we didn't have any disposals during the year. So the only thing we had for the year, TCI for a year. So you have to go back to the statement of profit and loss and pull the right figures. So this is test your knowledge. It's the minus 12 that goes to the NCI column, and it's the 1177 that goes to retained earnings. So we'll slot those two in first. Profits 1177, NCI minus 12. They're the first two. The FX reserve then, be careful, that comes from the difference between 1177, the profit share to the parent, and the TCI share to the parent, which is a loss of 173. Now, if you want to figure out where does that 173 come from, it is technically 80% share of the 191. So minus 191 times 0.8 and 100% share of the 21. Now 174, 173, there's just rounding going on. But that's important that you don't just put this is not the parent's share of profits. What's mixed in there is the FX reserve and the profits which go to retained earnings. So be careful when you're translating this into the statement of changes in equity. So we put in there the FX reserve minus 173. And you work back then to the opening balances. So the opening balance here in ordinary share capital must be 2 million. Again, nothing has changed in the year. The opening balance for retained earnings, 4859 minus the of the year, 3682. Opening balance in the NCI must be 143. And the opening balance on the FX reserve must have been 52. So if you add those across, you get opening equity and you get the TCI for the year. Right? So that's how your statement of change in equity works. Remember, these are all plug figures. You're just backing into them, but we can prove them now just to illustrate where they come from. So take, for example, group retained earnings. We want to prove what that was the 1st of the 8th of 2012. Well, we know the parent at the 1st of the 8th of 2012, that would have been, if we look at Ireland's retained earnings at that date, it would have been 4650 minus the profit for the year, 1070. 4650 minus 1070, it would have been 3580. And the only other thing that would have been in group retained earnings at that date would have been post-acquisition profit for the sub. We know the post-acquisition profit for the first year, it's actually done before, it was 230. The year one post-acquisition profit, 230 in bingos or 128 in euros, this figure here. You see the way they all link together? So the 133 was in the P&L this year, when you see it up here. The 128 would have been in the opening balances here. So that would have been 128 and their share 80%. And if we add those together, that means we're correct. that the opening balance would be on the group retained earnings, 3682. Prior year post-acquisition profits and the prior year retained earnings of the parent. So that's one of them proved. Now you don't need to do this for the exam unless you're specifically asked, but it's good for tutorial purposes to note everything does slot in. You just need to understand where. We need to figure out the NCI at the 1st of August 2012. Well, the value at acquisition, which was the 1st of August a year previously, was from working 2, 105. They get the post-acquisition profit of the sub as well, but they only get 20%. So 128 times 0.2 is 26. But you have to be careful now. What they also get is they're going to get prior year FX difference, 1 and 2, 20% of it. So we know the prior year difference here, FX 1 and 2, if you come to journal 1, we said current year is 191 loss, and we divvied that up. Prior year was a 60 gain. Remember we split that out, because it's 131 overall. So that's where the 60 goes. 60 gain, they get 20%. 60 times 0.2 is 12. And when you add those up, there's your 143, which matches the 143 up here. So those prior year, current year differences are important because they go in different places in the statements. And if you get those wrong, of course, you're going to lose marks. So your last thing then is the group FX reserve. Group FX reserve at the 1st of the 8th, 2012. FX difference, or say prior year FX difference, 1 and 2. So what you're doing, the 60, but they are now getting 80%. The group gets 80%, which is 48. And then prior year FX goodwill difference. The prior year goodwill FX difference, we said from journal 2 was a gain of 5. And see, do we have it labelled? That would have been in the P&L last year, which means it would have been, it would have been in the OCI last year. So it means it would have been the group FX reserve at the start of the year. And that is 5, and they get 100% of it. So there's 5. So you add them up, and there's your 53. I think mine might say 52, but that's because of rounding. Because technically, if you put this to 174 like I had, it would have been 53. So again, rounding for 1, there's no problem at all. But what you need to understand is, do you understand the difference between prior year and current year, where they go, and how they appear in the statement of changes in equity? It's not like they're going to be a line item here. They're going to be embodied in the opening balances at the start. Now that's very much moving towards an exam level question on IAS 21. But it's the same approach each time. You focus on initially translating the statement of financial position, figure out what's in the plug, retained earnings and FX differences. And if you need to, then you start worrying about current year and prior year splits. I think there's another question called dance there that has a prior year split as well. That might be a useful one to go on to after this when you're comfortable with the basics. All right. So that was looking at a question called Ireland Limited, question 8 in your pack.